Now, Shannon, I gotta say this. I thought that when you brought this up as your theme song, I said, oh my gosh, Shannon's just trying to be a teacher's pet. I chose Kenny Rogers. So Shannon's one of those that sits next to the teacher's desk and brings an apple, and she's choosing, but tell me the truth. Why did you choose The Gambler by Kenny Rogers?
Not to be a teacher's pet when it comes to food, and my husband is listening to me, but when it comes to food, I'm quite greedy. So I wouldn't be sharing my apple. But I chose it because not that I smoke and drink and gamble or anything like that, but
who among us doesn't?
Right. Well, I mean, life's a gamble, so why not? But you have to learn when to hold them, fold them, and run away, and it's so you can use it as a metaphor to life. When you go through life's journey, you end up learning, hopefully, what battles to pick up, what to run away from, and then, what's worth your time and what's not.
And you give us an example in your life of a time that you stayed at the table, or the time that you decided it was time to run?
Oh, that's a good one. Okay, so I'll use work as an example. I worked in the medical profession for quite some time, and it was just time to go. So I switched, but I stayed in the medical profession. I literally went across the hall to a different physician's office, and I saw the writing on the wall that he was about to retire, even though he kept promising another decade. So that's when I got up from the table and I ran away. So it worked out. It was a good gamble.
Oh, great. Okay, kudos to you on your song. That's really, really good. I love that song. Love Kenny Rogers. That's awesome. Okay, so your speaker on March 2nd is going to be Tom Shoshnoff. And if you've not done your reading for the week, y'all, I had insomnia last night, and I read your reading last night. So I read what y'all are supposed to read for next week. So no reason that even when you can't sleep, you can't do the little bit of reading that you got to do for next week. It's really good. Is anybody getting into your reading? You're kind of getting into it. It's kind of good. Okay. It's really simple too. And it's not textbooky. That's what I like. I didn't want something to be very textbooky. Look at the market. Go, baby, go. Look at it all of a sudden popping back up. I like it. Bulls, come on back. So let's do this. Let's hear our speaker give some advice. And Katie will really like this. So Katie, he's doing this thing. He's giving 10 questions to ask your financial advisor. Now, here's the thing. I don't necessarily agree with probably what he would say the answers are to all of them, but that's one of the great things, right, is we can disagree. So let's see what Tom Shoshnoff has to say. 10 simple questions to ask before hiring a financial advisor. And let's just talk about these, shall we?
Hi, I'm Tom Shoshnoff, and here are 10 questions.
Now, number one, God love Tom, but doesn't he look like a homeless dude that just rolled out, of the street or something? I'm like, unbelievable. It's hard to believe he's created a couple $1 billion companies and they're worth, a gazillion dollars. Hard to believe, right? But here's Tom asking what he would do, ask his financial advisor.
Questions that I would ask a financial advisor before I hired him or her. I think it's important that your financial advisor, would-be financial advisor, gets at least 7 correct and hopefully 8 correct.
All right, so we're going to pick on Katie today, make sure she gets 8 correct, okay, or 7. Katie, I'm picking at you, right? Okay.
Of the following 10 questions. Here we go. Number 1, are digital assets a suitable investment for a diversified, non-correlated portfolio?
Let's stop right there. I want to go to Juwan. Juwan, are digital assets, number 1, what is a digital asset? And number 2, is it a suitable investment for a diversified, non-correlated portfolio? And don't give me, well, it depends if you're mama's age and you're 94, if you're 18. Don't give me that answer. Give me the scoop on this. Are digital assets a suitable investment for a diversified, non-correlated portfolio? Juwan.
My answer would be no. I would say no. When I look at digital assets, I more so think of things surrounding like cryptocurrency that has kind of taken hold and really taken the world by storm. And the reason why I would say no is due to the lack of regulation and volatility and the amount of speculation that goes into the value of cryptocurrency. And it's not necessarily something that I am personally comfortable with, nor do I want anything to do with in this current moment. So yeah, there you go. That's my answer.
I like your answer. How about Kaylin? Kaylin, what do you think? Well, Kaylin, we've never seen you before. Welcome. Have you been hiding in the shadows and you're just all of a sudden now popping up? What are you doing? Or did you add to class late? Or have you been here the whole time? Where you been?
I've been here. My husband has been home. So I, just kind of closed out and wanted to focus on this.
Listen, ladies, all of y'all blaming stuff on your husbands. This has got to stop, okay? I'm up to here on that. No, I'm just joking. My wife's in the background, so she'll get on to me too. All right, Kaylin. So are digital assets a suitable investment for a diversified non-correlated portfolio? Yes or no?
I'm gonna say no. My answer is kind of similar to the last one, but to be fair and to just put this out there, I'm a hospitality management major. So a lot of the words are kind of going over my head at this point.
Is that your
But
husband?
I know
Or
with
please tell
digital
me that's your
assets
dog and
kind
not
of
your
go with
husband.
crypto, but I don't know what non-correlated means. So I'm gonna go with no, because that sounds more like it's one singular aspect.
Okay, so non-correlated means that the asset prices and values don't move in the same direction necessarily. They're not correlated to each other. So for example, you would think that, I don't know, you would think that Apple is probably highly correlated to what? What would you think Apple's highly correlated to?
I guess digital media, like electronics. Is that not the right?
Like NASDAQ or tech type stuff? Yeah.
Yeah,
I
think-
you got it.
like Silicon Valley.
Yeah. So how'd you get in this class? If you're a hospitality major, I'm so glad to have you because every student in Alabama should take this class. Did you just hear that it was an easy A and you said, I'm coming on over to Dr. B's class?
No, actually, I'd never heard of you before, but I'm
Okay.
actually really glad that I'm in this class. I like having the one-on-one, well, not one-on-one, but the class time.
Yeah.
Most online classes don't have that option.
You know why? Because the professors are still using the same lectures that they did 7 years ago.
Yep.
And it cheats you out of a right now experience. And I would never do that to you. That's why we do it live. Okay. So who in here owns crypto of some sort? I bet Isabel does. I can just tell by the look on her face. She's got that Cheshire cat grin going on like I own some. Huh?
My husband does.
Oh, good. Who does? Katie's husband does? There you go. Blaming stuff on y'all's husbands, ladies. I don't know what y'all's problem is. She's like, I would never do it, but my husband does. Okay. Yeah, if there are people, y'all, that have their entire life savings into crypto. It's crazy, right? They're the gamblers. Shannon, they're the ones that ought to be playing the gambler. I mean, they're gambling. Guess how much I have in my portfolio? $1.40. Nothing. I don't own a dang part of it. And guess what? I don't plan on ever owning any crypto. I think it's the biggest Ponzi scheme on the planet, in my opinion. Now, here's the thing, too. You talk about lack of regulation. Here's what's going to happen. As soon as the United States government, those greedy bastards, as soon as they get their claws onto something, they're going to control digital, right? They're going to say, well, now the dollar, and I guess the dollar is kind of digital already, right? How many of y'all actually have cash in your wallet? Let's see. Here's my wallet. Let's see how much cash we got in here. Zero. There's nothing in here. There's a bill or two. There's nothing in here. Zero cash. I don't carry cash. So we're kind of digital, I guess, already. And you can tell me about blockchain. You can tell me about this, but at some point, if crypto is ever the thing, the government will have its own crypto and they'll pretty much put everything else out of business. That's just my opinion. Now, if you're going to have crypto as part of your asset allocation, right, as part of your portfolio, I would keep it very, very small, very small. Like what percent of your overall portfolio would you put in there? Katie, what would you do? 1%, 2%? Yeah. Why are you giving us signs today? You're not going to talk to us today? You mad at us? What's wrong?
the back and forth of unmute, mute, unmute, mute.
Oh, I got you.
I've been doing it all morning.
Now, y'all know the easiest way to do it is to hit your space bar, right? So if you hit your space bar on your computer and hold it down, look at her. She's like, I don't have to hit a button. You just hold down your space bar while you're talking, then undo it and you'll unmute yourself. It's kind of cool. All right. So now what do you think Tom Sosnoff would say? Tom Sosnoff, what would he say? He would say, well, yeah, he would say, I think it's an important part of a diversified non-correlated portfolio. So, I disagree with Tom on this. He would say, yeah, digital assets are suitable. I don't think they're suitable. I would definitely never tell a client of mine, hey, baby, we're going into crypto, right? We're going into Bitcoin or Dogecoin or all those other coins. I would never say that. All right, so let's see question number 2. Question number 2.
Number 2, if I'm buying a stock, how can I reduce my cost basis? Will that improve my probability of profit?
Okay. If I'm buying a stock, how would I improve my cost basis? Now, I know what Kaylin's saying. She's like, look, I'm in the hospitality industry. I don't know what a darn cost basis is. What is cost basis of stock? Can someone explain that to me? Let's talk about cost basis of stock. If I buy a share of XYZ and XYZ costs $100 a share and I buy 1 share, what is my cost basis?
$100.
Very good, Juwan. It's $100. If the price of XYZ goes up to $125 and I get really excited and I buy another share at $125, if it goes up to $125, now what's my cost basis in my 2 shares of stock?
The total would be $225.
Yep, the total invested would be $225, but my cost basis would be what per share? $112.50. Everybody got me?
Gotcha.
So basically, my cost basis is my, average cost of shares. So if I bought, if it goes down to 50, then you add up the 50, the 100, and the 125 divided by 3 to get your cost basis. So that's how you determine the cost basis of the shares that you own. All right. So Tom Shoshnoff just said, ask your financial advisor, hey, how are you going to help me to reduce my cost basis in the shares that I got? Does anybody have a question? Anybody have a answer as to how to reduce your cost basis?
I don't
Wow.
suppose it would be simple as just waiting until it gets lower and buying more.
Virgin, am I frozen?
No, you're not frozen, Jamon.
Oh,
But by the
okay.
way, though, that
Did you hear anything I
reminds
just
me of a
said?
song. That reminds me of my little kid song, my 5, 6, and 7-year-old. Y'all want me to do it? Let it go. No, I won't do it. All right, Juwan, go ahead. What were you going to say?
Would it, in regards to reducing cost basis, would that have to do with as far as when you are actually investing? So if we want to get like super technical, we could mention something like dollar cost averaging. So that way you are having a consistent investment that is, you're investing, let's say that $100 when the market goes up, you're investing that $100 when the market goes down. And of course, when it goes up, you're able to buy less. When it goes down, you're able to buy more. And then wouldn't that in turn kind of balance out what your actual cost basis is?
I'm watching you, Juwan. I'm watching you.
I'm just really nerdy.
Yeah, I'm watching you. But you know what? At the same time, I'm watching Kaylin too, because she's got a great idea, right? She's just, Kaylin's in the hospitality industry, so she's not maybe as technical with the terms, but both of y'all are kind of onto something here. Y'all are give each other 5. Kaylin, give Juwan 5. Y'all are the stuff of champions. I like this. So y'all are on the right track. Now, here's what I'm going to tell you right now. Let's stop the session right now just for a second. And let's take a little break because I'm going to share something with you. You ready for this? I don't want you, ladies and gentlemen, to ever buy stock, ever, in a traditional sense. Now that's going to surprise you coming from an investments class, right? I don't think there's a place that you should ever go out and go, huh, let me tell you what I'm doing today, Bob. I'm going to buy 100 shares of Apple, baby. You should never do that. You should never do that with your clients and say, hey, you know what? Let's go buy 1,000 shares of a stock today, because that is D-U-M-B dumb, right? To just go out and buy shares of stock. All right. Now that I've said that, I want somebody to give me a stock, a popular stock, or maybe even a stock that you own. And I'm not going to call you dumb because you own stock. But who in here owns some stock? Anybody would share? Okay, Katie, what do you own?
Oh gosh, we actually own this stock. NVIDIA is one.
NVIDIA, right?
Mhm.
Do you know what your cost basis is in the NVIDIA?
I could tell you.
Oh my gosh, look at this. Listen here, Tubby. I'll tell you in just a second. Let me look it up. And don't call me Tubby again, Katie. That was highly inappropriate. Would you not do that? Okay. So let's go look at NVIDIA, shall we?
Yeah.
So she's looking up her cost basis in NVIDIA. She's probably owned it. She's probably a multi-gazillionaire because of her.
2.5 years. And I'm trying to get details on it.
Let me pull up Tom Shoshnoff's his brokerage, and we'll look at it over there. It's the visuals of Tom Shoshnoff's little brokerage here are a little bit better than Thinkorswim, but they don't have a paper account, so I can't help you guys to do stuff over here. So NVIDIA, let's look.
And I'm going to blame my husband again because this was one that he wanted. So it's in his one of his IRAs. He bought 2 shares. The cost basis was $751.31.
$751 and something cents, and now it's $169. Okay. It may have, did it split since then or do anything?
It did split.
It did split. Okay. So yeah, so she's telling you what the cost basis is. So it's got now an adjusted cost basis because of the split, right? So your cost basis should be less than that. But kind of here's the daily chart of NVIDIA. We won't spend a lot of issues on chart, but I want to make sure that everybody knows in your brokerage thing here, if you wanted to trade NVIDIA, right, there's a bid and an ask price. Now, does anybody know where I would buy and where I would sell? I can click on one to buy and I click on one to sell. So if the price, there's a spread here. Does everybody see the spread? 10, 12 to 14, 14 to 16, spread 13 to 16. What does that spread represent between the bid and the ask? Where would I buy? Would I buy at a lower price or would I buy at the higher price? Remember, the market's there to screw you and transfer wealth and take your money. If you're buying the stock, would you buy at the higher price or the lower price? You would rather buy at the lower price, but where is the brokerage and the market makers going to sell you the stock? At the higher price or the lower price?
Ask.
There you go, the ask. So you click on the ask to buy 100 shares of stock, right? So this would say buy 100. Now I could buy less, right? But this by default brings up 100 shares of stock. So, and you can adjust your price down to the mid price, or you can go to the net price, but you try to work the price a little bit if you're doing this for your client, you're buying or selling stock for them. But let's see what this risk graph looks like, shall we? Let's look at this and see if I can get this. So this looks like, where's it at, Bob? Trade curve. We'll go to curve and we'll go to analysis. So this is the risk graph of buying 100 shares of NVIDIA. If the price goes up, we make a money. Everybody see the green, right? If price goes down, we are in the red, which means we lose a money. Everybody's with me so far. Very simple, right? Caitlin, you comfortable with this, right? This is hospitality. This is like, what can I put it in hospitality? This is like the tables turn like this, you see? You know, and stuff is sliding off the table. So if price goes up to 175, you make $587. If the price goes up to 195, see, I'm looking at these little prices up here at the top. So if price goes up to 195, you've made $2,500. If price goes up to 205, you've made $3,500, so on, so on. If the price goes down to 155, we've lost, what is that, $1,300? Price goes here, we've lost $2,400, so on and so on. Any questions about the risk graph? Okay, so everybody knows that. Okay, so your client comes to you and says, I want 100 shares of NVIDIA, buy it. And you say, oh, hold on a minute. Dr. Bob told me that I should never buy stock outright. Here's what you should do. Does anybody now know a better way to get into stock than just buying it directly? Oh, y'all gonna love this. I can't wait to see the aha moment on your face. You ready? If your client or you actually wants to buy 100 shares of stock, how about this? Sell a put instead. Bingo, baby. This is going to be eye-opening. Now, how many of you have had an investments class before at the college level or in high school level? Katie has. Do you remember, Katie, when your professor got to options? They said, Katie, options are highly speculative, and we really don't talk a lot about them because they're not appropriate for the average investor. Next, let's go to, whatever. Isn't that what they did?
I took futures and options
Oh
And,
my gosh.
my senior graduating semester, so I didn't really take it all in.
You didn't take it all in.
No,
Oh,
I didn't
my
think I was gonna do this as a career,
Oh,
but it was,
okay. Well, what is a put? What is a put, Katie? Do you know what a put is? She took the class, but she didn't pay attention because she's like, screw this. Who in their right mind would do this crap? Next thing you know, she's doing this crap.
well,
All
we don't, our firm doesn't, so I really don't, I'll follow my sword here. I remembered it for the Series 7 and let it go.
Let it go. There she goes. Let it go. Okay, what is a put?
A put specifically is an option where, depending on which side of the spectrum you're on, you're either looking for it to increase in value or the stock to increase or decrease. So if we're buying a put, that means we're wanting it to decrease. So that way we are able to, call up, put down. Yeah, we're wanting, if we're buying a put, we are wanting that the value of the stock to decrease. So that way we're able to, once it hits the price, we're able to buy it at a lower price than what it was. I feel
Look
like
at
I'm
that.
confusing something in there,
No,
but
no, you're doing good. So a put option is a contract that gives the option buyer the right, but not the obligation to sell or sell short a specified amount of an underlying security at a predetermined price within a specified time frame. Oh my gosh. So y'all can kind of look at this, and say, what is a put? You can, is buying a put, is that bullish or bearish? And first of all, we got to make sure Caitlin knows what bullish and bearish is. What is bullish? If I say something is bullish, what am I, Caitlin? Do you know? We'll make sure she's with us.
Yeah, so the bears are when it's going down,
Yes.
right? And the bulls are when it's going up.
So if I'm bullish on Apple, I'm trying to put on a position that will benefit if Apple goes up, right? So I'm a bull. I'm a bear on Apple. I'm bearish Apple if I think the Apple will go down, and therefore I'll try to do something that would make money if Apple goes down. And Juwan, you're exactly right. If you buy a put option, that gives me the right, but not the obligation, to sell a specified amount of the security at X price. So let's see what that looks like. So you know what a risk graph looks like of the shares of stock. So what does a buying a put look like? So let's say that we go back and clear our order. So this is what is called an options chain. Options expire, ladies and gentlemen. So you can have one that expires in 1 day, 8 days, 15 days, 22, all the way out for over a year, right? We can go a year out. And so if you're bearish on NVIDIA, then I could go out, I don't know, let's go here to the 57 days. And you think in the next 2 months, it's going to go down. So puts are on the right side. See this, puts. Calls are on the left side. NVIDIA is currently trading at 169. So you have some out of the money puts, you have in the money puts, and then you have a bid and ask on the put. So if I wanted to go over here and let's say, you know, man, I think this thing is going to drop like a rock. I would love to be able to buy NVIDIA or not buy NVIDIA. I would like to be able to sell NVIDIA, you know, at a lower price. So what you could do is go in here and you could buy a put. And a put, buying a put represents 100 shares. You control 100 shares of NVIDIA. So if I'm buying a put, here I am. This has a 19% probability of profit. Shannon, how's that make you feel with your, is Shannon still here? Shannon, does that make you feel good with your gambling song? It doesn't, does it? It's a 19% probability of profit. You have a 62% probability that you're going to make 50% on the trade. Your max profit would be if NVIDIA goes to what? 0, right? Because this is a bearish trade. So your max profit would be if NVIDIA goes down. And your max loss is the amount that you spend for the put options. So they're $4.15. You go, man, that ain't bad. But remember, options are quoted in 100s. So if I'm paying $4.15, you've got to multiply that times 100. That gets you the $415 that you'd be spending. So if I was going to put in that order, right, it would say, you know, $415 debit. That's my maximum loss. My maximum profit is if NVIDIA goes to 0. Now, what does this look like? Check this out. Let's see what this curve looks like. Look at this. Wow. So this means if I'm wrong and NVIDIA goes up, I lose my $415. Everyone see that? It's total thing. But if NVIDIA were to go down, oh, happy, 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 happy day. Because I make tons of money on the downside. But remember, this only has a 19% probability of profit. I don't like that. So let's say you want to do the exact opposite. Let's say rather than buying a put, you sell a put. Now, wait a minute. How can you sell something that you don't even own? That's the weird thing, right? In options, you can sell options that you don't even own. Now, the problem is if you sell an option, you don't have the option. You have an obligation. So in buying an option, you have the obligation to do something, whereas with selling an option, you have you have an obligation. With buying an option, you have the option to do something. I hope I'm making sense with this. So let's go see what that looks like. So if your client or you are interested in buying 100 shares of stock, what you should do is rather than buying an option, you should sell an option. So let's see how this works. So let's say we go out to that same 57 days. Let me clear this order. Clear the order. And let's say that we're going to sell an option. So let's go to the 57 days again. And you think, hey, man, in the next 57 days, I'm going to reduce my cost basis. I could buy the option at 165 today. I'm entirely happy to do so. But what's this? Let's say that I want to sell an option. So I'm going to sell on the bid, right? And I'm going to collect a premium, and you sell the 145 strike. So we're roughly, what, 28 points below the current price. So if I sell the 145 strike, I can bring in $520 today. Now, some of y'all are sitting there going, gosh, Bobby, I don't make $520 in a week. You could bring in $520 today, give yourself a 77% probability of making profit. If you closed it at 50% profit, you've got an 88%, 89% probability of making profit. And your max loss, though, is what? Whoa, $13,980. That seems like a lot. But remember, ladies and gentlemen, you wanted to buy the stock at 169. If you bought 100 shares of stock at $169, what is your maximum loss on the 100 shares of stock if it goes to zero? Caitlin.
I was trying to do the math. I'm feeling somewhere in the $16,000 range.
Yeah. So it's $16,900. If you buy the stock for 169 and you got 100 shares, if that goes, you just spent $16,900. If that stock goes bankrupt and goes to zero, you just lost $16,900. So this looks scary, right? But remember, you're bringing in, if we get it filled for $5.20, you're bringing in $520 today. $520. That is yours to keep. Now, what if the price in the next 57 days closes at 155? Guess what you get to keep, Isabel? The $520.
The 520.
Now, if it closes, if the price of NVIDIA closes anywhere above 145, if it closes at 145 and a penny, you're not going to get assigned the shares. If the price of NVIDIA closes at 145 or below, then you're going to get assigned 100 shares at what price?
145.
145. Now, do you see how you can reduce cost basis with a client? Y'all, this is powerful. I want you to think about it. They're willing to do this. They're willing to spend, hawk out $16,500 or $16,900. And you say, hey, Mr. Client, rather than doing that, sell a put, make $520. If NVIDIA stays above here, you get to keep the $520. If NVIDIA closes below, then instead of you buying it at 169, you just bought it at 145. Win-win. I hope little light bulbs are just dinging in your little head. I hope you guys are going, oh my gosh, this is the greatest thing ever. Evan said he got about 2 hours of sleep last night. Yeah, man, I'm on all kind of mood stabilizers and Adderall. I got the Adderall, I got the Effexor, I got all this medication I'm on. It just keeps me up in the middle of the night. Yeah, it's bearish, Juan, buying a put. You got it right. So it's bullish, selling a put. So think about how cool this is, y'all. I just love the light bulbs going off in your head. And Katie, can you imagine how powerful this is? You just saved your client. If the price does go down, you save them what? $20 or more a share. They think you're a hero. They wanted to buy here. You said, hey, let's buy it at 145 if it goes down. If not, let's keep our $520. Now, what if they wanted to buy 1,000 shares? Let's move our contract to selling 10 of those, right? So this would give them the opportunity to buy 1,000 shares, 10 contracts. How much money are they making now? $5,200? Wow. Hercules. This is the greatest thing since sliced bread. But keep in mind, if the price does close below the 145, you are obligated to buy it at 145. It will be put to you at 145. Again, that's why they call it a put. Your broker, you will wake up after expiration if it's below 145, and you will have 100 shares. In this case, you would have 1,000 shares in your account, and your cost basis would be the $145 less the credit that you were able to keep for selling the puts. Questions? Anybody think this is the greatest thing since sliced bread? It really is. It's cool, right? So now you know you've got a better way of getting into stock. So now you ladies that were beating up your husband for buying you stocks and getting into the crypto and stuff, you can go knock him over the head and say, why the hell didn't we do this? Right? Well, the reason is because they don't teach this. Nobody teaches this anywhere. So now let's say, I don't want to get too, let's don't go into the calls today. I don't want to go into the calls today. I don't want to overly confuse you. I want to finish up with Tom Sosnoff, and we're going to go into much more depth on this, but I want you to know that options give you options. Options give you great ways to trade around where the current price of a stock is to reduce your cost basis. Questions? All right, good. Katie, did you remember that much from your options class, or did they not teach all that? I'm always
I
curious.
did,
What they
and then the chart with the calls and the puts chart.
Yeah, you did the calls and puts chart. And did they talk to you about reducing cost basis on shares and
No.
buying it floor? Yeah.
I went to that other school, so a lot of what I talked about was commodities.
Auburn?
I'm a Cal College grad. True ag degree.
I told y'all about my sister, right? She graduated from Auburn and now she's a drug dealer.
I was before this.
Oh, really? You were a pharmacist? Oh, you were in the pharmaceutical business, right?
Okay.
She's a pharmacist, all right. Yeah, she's a pharmacist.
Well, I was a
So-
pharmaceutical rep.
Yeah, okay, good. So everybody that goes to Auburn ends up in drugs in one way or shape, form, or fashion. So that's good. No, we love our Auburn people, no doubt about it. So okay, so that's that. So let's go back to Tom Sosnoff and see what his other 10 questions, his other 10 things are. All right, so y'all know the answer. Y'all know that, yes. Now you know, Katie, you probably knew before how to help reduce cost basis, how to get into a stock lower than the current price. And we'll talk about things you can do after you own the stock to reduce your cost basis. So let's go into some more of these questions.
Number 3, what's more important, liquidity or having good market instincts?
Okay, what's more important, liquidity or having good market instincts? Now, I'm picking on Caitlin a lot today because she's in, she's in a non-related field, so we want to make sure she's totally up to date. Caitlin, what is liquidity?
I know what that means. That means that you can sell something or get rid of it for money.
Quickly, right? Right. So if you got wacky weed and you're living in Opelika, Alabama, there's a good chance you can convert the wacky weed into cash really, really quick. If you've ever been to Opelika, you know that to be true, right? So if you've got what would be not liquid? If you've got a timeshare for a condo in Opelika, Alabama, hell, you ain't getting rid of that. Ain't nobody gonna give you money for a timeshare in Opelika, Alabama. That is what we call illiquid. Illiquid. So what's more important, liquidity or having good market instincts? What do y'all think?
Liquidity.
Liquidity. We want to be able to get out of the asset. Let's take a mental break, shall we? Let's just sit back and tell a story. So I owned rental properties, a bunch of them, back in 2008 when the economic collapse came. And y'all, I couldn't rent a house, one of my rental houses. And there was this one particular house, 203 Campbell Avenue in Bowden, Georgia, that just sat there. And sat there. I couldn't rent it. I couldn't sell it. I couldn't do anything. And I was having to pay the mortgage on this house every month. And I was like, this is getting old. So we went to church that night. And the pastor said this great thing. He was like, listen, whatever the mountain is in front of you, he said, I want y'all to do this. He said, I want you to go to that mountain and I want you to yell grace. He said, don't do it one time, do it 3 times. He said, grace. He says, grace, grace, grace. He said, and see if God doesn't move a mountain in your life. You know what we did? The moment that we left church that night, me and my family went in the old wood-sided station wagon, drove up in front of 203 Campbell Avenue in Bowden, Georgia, rolled down the window. I said, family, we're going to do what the pastor said. I said, we're going to yell grace 3 times at this thing. We're going to believe that God's going to get this thing out of our hair. And we yelled grace to the top of our lungs 3 times. 2 weeks later, I had a contract on it, and that property was sold within a month. I was like, and it's in there for a year. So that's why I give y'all a lot of grace in this class, right? There's a lot of things in our lives that are problems, There are a lot of things, and I just kind of take it slow. Nobody get, out of shape, get bent out of shape, enjoy the class, have fun. And so that's why I give you a lot of grace. But that home was illiquid. I could not convert it to cash to save my life. So I much prefer trading options and futures and stocks than trading in real estate, because real estate is very illiquid. And when you're trading financial markets and you're dealing with an investment advisor, you need to make sure that liquidity is important. That they know that liquidity is important, because if you buy, let's say that you work for XYZ Corporation and it's a publicly traded company, but it's not liquid, y'all, that's hard to get out of, and it's hard to find a buyer from it. So there are times when you're going to want to get out of a product and you need it to be liquid. And we'll talk about the characteristics of liquidity securities at some point, but I just want you to know liquidity is very important.
Number 4, if I buy the following ETFs, SPY, IWM, and QQQ in equal percentages, do I have a decent, diversified, long equity portfolio?
Okay. Does anybody know what SPY is? It's not like James Bond either. Who knows what SPY is?
Isn't that one that's just following one of the markets? Am I on the wrong, the S&P?
Yeah, the S&P. It's the S&P 500. Yeah, it's an ETF that tracks the S&P 500. That's exactly what it is. All right. Does anybody know what IWM is? You probably don't know what IWM is. IWM is like the Russell 2000, right? It's like the Russell. It's this small cap stocks. And does anybody know what QQQ is?
Is that
Mostly tech.
Yeah, it's the NASDAQ. It's the ETF that tracks NASDAQ. The NASDAQ 100, right? So S&P 500, IWM, I think it's Russell, I think it's 2000, and QQQ is the NASDAQ 100. So if I own 33% SPY, 33% IWM, and 33% QQQ in equal percentages, do I have a decent diversified long equity portfolio?
I'm just gonna say no, because I feel like you need other things in there too to make it diversified, like bonds and stuff, right?
Look at Kalen.
You're saying equity though.
He's saying long equity, but I kind of, the long equity may be the only issue that he's doing here. But I would say that, Kalen, you're absolutely positively right. I would give kudos to you and say, yeah, because guess what? Most of the NASDAQ QQQ is in the S&P 500, right? So Apple is in both the QQQ and SPY. I think Tesla's in QQQ and it's in SPY. Now the IWM gets you some smaller cap stuff. So, this one is kind of 50-50. I agree with Katie too. You're getting a good exposure to long equities, and equity meaning shares in companies. But at the same time, you've got a lot of overlap, especially between that SPY and the QQQ, right? You got Microsoft in SPY and Microsoft in QQQ. So you're getting a little bit too much exposure to a lot of the same companies. That's my opinion, okay? But a great question and great answers by both Katie and Caitlin. All right, let's go to the next one.
Number 5, is there an accurate way to know what the probability of the S&P 500 closing up 12% will be in 2023?
Oh, this is a good one. Is there an accurate way to know what the probability of the S&P 500 closing up 12% will be in 2023? Can you give an accurate estimate of what that will be, or would it just be a pie in the sky guess?
Not going to be accurate.
It's not going to be accurate?
I mean, if you look at it, is there an accurate way to know what the probability is? We can look at historical data, but everything else is speculative.
Katie, I want you to do me a favor. Will you do me a favor?
Yeah.
Oh no, don't hide your face. You're scared, aren't you?
Yeah.
I want you to remind me on Tuesday to show you how to accurately predict the probability of price in the future. Because here's what happens. Do you ever watch CNBC? Now, some of y'all that work at investment firms and everything, you know, they probably got CNBC on out in the, you know, the lobby or whatever. And they got these yahoos that come on there and they'll ask them, excuse me, Chuck, what do you think the prediction is for the S&P 500 at the end of 2023? And you know what Chuck does? He pulls an answer out of his butt because he don't know. He ain't got no idea. But I can show you with probabilities how to give a very intelligent answer that is based on probabilities, so that you, Katie, when you get to be on CNBC, you're going to be able to back up your answer. You will not pull yours out of your rump. You will not. You are going to be able to basically say, within a 68% probability of, probability of the bell curve, S&P should close between this number and that number, and here's the probabilities. How about that? So here's what I want you to do, Katie. If you'll just simply tell me this on Tuesday at the very start of class, Dr. Bob, show me how to be smarter than any CNBC analyst or contributor, and I will show you how to be that person. Got me? Wonderful.
I'm gonna miss Tuesday, so I'll send you an email.
And just where are you going? No, I'm just joking. Okay, we're gonna miss Tuesday. Shannon, will you pull up the Slack on that? Will you be that person?
I got you, Kate.
Shannon's gonna do it. She's got it. Okay, so let's go to this.
Number 6, if I think interest rates are headed higher, how do I invest to profit from higher rates?
Okay, who wants to answer this one? If I think interest rates are headed higher, how do I invest to profit from higher rates? Any answers on that one? Y'all don't like the old rising interest rates, huh? Hey, Juwan's gonna try it.
Would it be to go toward more fixed income securities and or things surrounding like bonds? Because generally when interest rates go up, the price of bonds go down, but their yields are generally higher.
I can buy that. Yeah. And a lot of times when the rates increase, what happens to the stocks? What happens to the price of stocks? Yeah, they go down. Why? Because mama and papa is watching, the late news, and before they go to bed, and they hear about rising rates, and then they think that they can get more money in their CD with more safety than they can in the stock market. So people start pulling money out of the stock market to chase higher interest rates, because dollars chase what? Dollars chase higher returns, right? Dollars will chase higher returns. That's why when people were making hands over fists in money in the crypto, people were chasing that. And then all of a sudden over the last year, we had a major correction in crypto. So now are dollars flowing into crypto as much? No. But if you were going to invest in crypto, now is a better time to do it than it was probably a year ago, because that asset has had a correction. And if you were going to buy, I would never buy, but that's kind of my opinion. Let's go to number 7.
Number 7, if the S&P 500 goes down by 6% in 2023, and I only lose 2% after fees, did you do a good job for me?
We got to go to Katie for this one, don't we? Where'd she go? Did I already run her out? I don't see her anymore. Katie, you still there? Bless her heart. She's already gone to Tuesday.
Sorry, I just had some clients walk in early, so.
Hey, how y'all doing? Y'all come on in. Take a seat. Sorry. All right, Katie, if the S&P 500 goes down by 6% and I only lose 2% after fees, did you do a good job for me, Katie?
I mean, we still lost money, but I do have people in the lobby, so I hate to do this. I've got to go.
Katie, you got to go. Tell them I said, hey, okay? And we'll see
Thank you.
next Thursday. Bless her heart. Don't you know she's stressed out? She's like, I hope he didn't hear that guy talking to him.
Number
All right, let's
8,
go to number 8.
is there ever a good time to invest in third-party managed products?
What's a third-party managed product? Can someone Yeah, what was it, Caitlin?
Middleman?
Yeah, a middleman. How about this? That would be like, is there ever a time for me to invest in a mutual fund? Right? Or how about this? How about the Kathy Wood ARC fund, right? That she's got. So is there ever a good time to invest in third-party managed products? What do you think?
I mean, I'm just gonna say this. I don't think so, because if you have a third party, there's a middleman. So there are extra fees and they're pocketing any money that you would have been making.
Okay, I can buy that. I mean, I could buy sometimes that there is, sometimes there's not. I mean, I don't think there's a clear answer here, but I kind of like what you're saying. Why give someone else money if I can do something myself, right? So if you can do it yourself, and that's what we're going to try to teach you in this class, is that you don't need a financial planner, that you can do most of this stuff yourself. Now, wait a minute. A lot of y'all are in here to become financial planners, but in a class of 50, how many of y'all did we say are going to become financial planners? 1, 2, 3 of you. Some of you are already in there, so you know that's good. But a lot of you aren't. Is Kaylin ever going to become a financial planner? Well, she doesn't know. She might, but chances are she's not. Okay, let's go to 9.
Number 9, is selling a naked short put a good way to get long stock?
Okay, you know the answer to this, Kaylin. Send it to me, girl. Tell me.
No. I need to rewatch the first half of this because I was a little confused still.
Okay, well, we'll go through it in greater detail, but selling a naked short put, and naked may have thrown you off, right? But that's what we did in the example. We sold a put in order to get long or to buy stock. So some of these words, naked, short put, these things are kind of getting in the way. And so we'll explain all these things. So basically, to get long stock means to get bullish stock or to own stock. A naked short put means we sold a put, right? So yes, selling a put, forget the naked, is a good way to own shares of stock. So you got it. Y'all are doing great. So let's go on a little bit more here. Number 10. We're
Number
closing
10.
up.
How do you protect us from another market meltdown?
Wow.
Woo!
How do you protect us from another market meltdown? Kaylin.
A diversified portfolio.
Okay. Okay.
Is that not what you're looking for?
That's a good answer. Listen, I'm not saying there's any right or wrong answers here. I want you to be free thinkers, right? There's not just my way or the highway in this class. I want you to actually have opinions. But I think the diversification is good. I will also say that diversification, okay, listen, some diversification is good, but also diversification is overhamped a little bit. What was the word I wanted? I had it in my head. I can't. What is the word I want to use? Dang it! All those drugs. Overhyped. Yeah, diversification is good, but if you've got 50,000 stocks in your portfolio, you got too much diversification. If you've got, too much garbage in there, it's going to take your returns down a lot. So we'll talk about an ample amount of diversification, but not too much diversification. It could be a double-edged sword. All right. Any questions on today's class? Hasn't this been fun? Hey, Juwan,
I have
you got a
two questions.
Yeah,
I know I
questions.
talk a lot.
No, you're good.
So my first question is in regards to market meltdown. No matter what, while yes, you can limit the kind of losses that you experience through diversification, kind of like you mentioned, you can only diversify up to a certain point because there is a certain risk that is not able to be diversified out. And I believe that's considered like non-diversifiable risk. So there's like the risk that you can diversify, and that's depending on markets and various industries and things like that. But then no matter what, if the market goes down, the market's going to go down, and that's going to be across just about most investments. So that's my first thought for that question.
Okay.
Feel free to.
No, I like that answer, and I don't want to keep y'all long, so we're kind of out of time, but I'll say this, Juwan, I'm going to give you an assignment for next class. I want you to remind me at the beginning of the class, hey, Dr. Bob, tell us the story about how during the COVID crash where the market dropped 35%, that you made 208% in your entire portfolio.
All right, noted. And
Because
then,
because
oh, sorry, go ahead.
I went to Red Lobster that day, baby. Huh? I was eating high on the hog. I went to Applebee's for a whole month after I made 208% I joke and I kid. I don't want
Cheddar Bay
I don't want
biscuits.
yo Cheddar Bay biscuits, baby. I love them things. And let me tell you something. Let's talk about Applebee's a little bit. If you go to Applebee's and get the Fiesta lime chicken, oh y'all, and then get a side of their what they call dumpling sauce on the side. Oh, but don't eat their rice. Their rice tastes like it was come out of a blender or something. Add the mashed potatoes instead.
So we see you've had this once or twice before.
Oh, so good.
And then my last question and or thought is, so this individual is referring specifically, Tom is what he goes by, is referring specifically to talking to a financial advisor.
Yeah.
And based off the questions that we're asking, I feel like wouldn't a financial advisor, actually be advising more than just investments? So when you're looking at the conversation of who you'd be having this with, this will be someone that is more investment specific because advisors do more than just investments.
Yeah, but I would say at a minimum, right, if they're not able to, the number one thing I would ask is this, and I agree with Tom on this. Out of the 10 questions, here's the most important question. Can you show me how to lower my cost basis? And if they can't show you how to lower your cost basis, you probably don't need to hire that person. I don't care what else that they're doing for you. If you're hiring people specific for, estates and trusts and wills and things of that nature, that's one thing. You wouldn't ask them that. But if they're at all dealing with your investments and they can't tell you how to help you reduce your cost basis, because did you know, Jawan, that it's possible to own Apple and have your cost basis at zero?
Would that be because that would be an mutual fund and the ownership of Apple is a part of the mutual fund and not exactly Apple itself?
Yeah, not necessarily, but I see where you're going. It's more through what the abilities of what you can do with options around the stock. So for most people, when they own stock, they own it like I would own 50 acres of land out there in my backyard. Hey, I got 50 acres of land. Isn't that great? And it sits there. Does it make me any money? Well, it pays a little dividend every year. Okay. So that's not a lot of money. And then all of a sudden, I go, wait a minute. What if I put a little bed and breakfast out there? I put me a couple of double wide trailers on the property. I build me an apartment complex. I set me up a bingo hall and a dance hall, and I put out a liquor store out there. Now, all of a sudden, I have turned my stock into income producing property. So what I'm going to show you in this class is how you can take your stock and turn it into an income producing property for you. How about that? I'll leave you with that little teaser. All right, everybody good? All hearts content?
Yeah,
All
thank
right.
you.
Y'all are a great class so far. And by the way, I know there's like 13 people in here, and I'm only picking on the people that like I have the thing. If some of y'all else want to participate, please do. We want you to all be like Tasha, for example. Tasha has her MBA. That's great. Hey, Tasha, can you talk, or can any of you others talk in here? I want to get you all involved. It's just that I see who likes to talk.
Good afternoon.
Hey, how you doing?
Good, thank you. Hi, everyone.
So I'll try to start talking to some of the people that are not on camera as well, because not everybody wants to be on camera. I'm the only one that's really comfortable in front of y'all sitting in my underwear and not shaved and just rolled out of bed. I'm fine with that. Right? Some of y'all don't want to be seen this early in the day. I got you. All right, y'all, roll tide. Y'all have a great rest of your day. I will see you Tuesday.